Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at HIMS and HERS Health.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
All right. So looking at HIMS and HERS, the big picture here, the main thesis, is that this company is really making a shift, isn't it?
It is. It's moving from being, a sort of niche digital health name to a pretty scaled cash-generating platform.
And I think our goal today is to really figure out if that acceleration is, durable, can it last, especially with all the competition out there.
Exactly. And the best place to start is always the numbers.
And we have to start with those Q3 2025 financials because some of the headline figures were certainly attention-grabbing.
Yeah, they were. The revenue came in at $599 million. So they're knocking on the door of $600 million in a single quarter.
That's huge. That's 49% growth year over year. For a company operating at this kind of scale, almost 50% growth is incredibly robust.
It is, but you do have to put that 49% number in context.
Okay.
If you just look back one quarter to Q2, their revenue was $544.8 million. That was a 73% year-over-year jump.
So that's the thing. When investors see growth decelerate from 73% down to 49%, that can set off some alarm bells, can't it?
It can, but I think this is where you have to ask why it's happening. Is it a sign of weakness in the business, or is it just math?
Right, is that law of large numbers kicking in?
It's a textbook case. The company is so much larger than it was a year ago. You just can't maintain a 70+% growth rate forever when your annual run rate is pushing $2.4 billion. It's not realistic.
What's more important, I think, is the absolute dollar growth and the sequential growth from Q2 to Q3. That's still clearly there. The business is still expanding quarter over quarter.
That's the key. But the story gets, I think, a lot more interesting when you look below that top line, when you get into profitability.
Because that's the signal that the platform actually has leverage. And we're talking about their gross margins here.
We are. For Q3, the gross margin was an incredible 73.8%.
73.8. Let's just put that in perspective. Their cost of revenue was just over $156 million against almost $600 million in sales.
Right. And that metric is so critical. It tells you that as they add more subscribers, the cost to actually serve them is incredibly low. It's almost like a software company's cost structure,
right,
which is very rare in healthcare.
It shows the whole thing is scalable. They're not getting bogged down by, physical clinics or that kind of infrastructure. Every new customer just drops a huge chunk of that revenue straight to the bottom line.
And that margin profile just fundamentally changes how you have to value the business. It's not a risky startup anymore. It's a proven platform that can scale profitably.
Okay, so when you see that kind of financial health, great growth, amazing margins, cash flow, the next question is always about management. Do they believe in the company? Do they think the stock's a good deal?
Absolutely. And how they use their capital is probably the loudest signal they can send.
And what they've done recently is, it's extremely aggressive.
It is. They just authorized a new $250 million share buyback program on November 13th. That is a massive vote of confidence.
What's really telling to me, though, isn't just the size of the new one, but how fast they went through the last one.
Yeah, that's a great point. Between October 1st and November 7th, so just over a month, they bought back 1.3 million shares for $55.5 million.
And that completely used up their previous $100 million program. It signals that they saw an opportunity and just jumped on it.
It does. And for anyone looking at this from a technical perspective, this is really important. If you just do the basic math on that $55 million they spent,
you get the average price they paid.
Yeah. Exactly. It comes out to roughly $41.60 a share. That number basically acts as a valuation floor set by the company itself.
It tells you that the insiders, the people who know the most, were happy to deploy a lot of cash at that $41.60 level.
That's the real insight here. They are signaling to the market that their internal models say the stock is a buy at that price. For you as an investor, that creates a pretty powerful technical support level.
And it creates a tailwind, right? Because buybacks reduce the share count, which makes the earnings per share, the EPS, go up over time. It's accretive.
Right. It systematically boosts the per share value over the long haul. It's a multi-year tailwind you have to factor in.
So we've got strong financials. We have clear management conviction. But like you said, telehealth is a crowded space. So how does Hims and Hers actually defend its business? What's the moat?
This is the absolute make or break question, and I think they have a multi-layered moat, really. The first layer is their whole operating model.
The direct consumer,
Or
the DTC network effect.
precisely, they own that entire patient journey.
Explain what that really means for the listener. How does owning the journey create a moat?
Well, by cutting out the middlemen, no outside clinics, no fighting with insurance companies, they get two things. First, better unit economics, which leads to those high margins we talked about.
73%, yeah.
And second, they create really high switching costs for the patient. Your medical history, your prescriptions, your doctor relationship, it's all inside the HIMS platform.
So if I wanted to leave, I'm not just changing brands. I have to completely restart my medical journey somewhere else, which is a huge pain. That friction is the switching cost.
Exactly. And that stickiness leads right into the second layer of the moat, which is brand and trust.
Right. They've really become the go-to name for accessible care in a few specific categories, haven't they? Like sexual health and now GLP-1 weight loss.
They have. And that brand equity gives them pricing power.
Yeah.
It also means their customer acquisition costs can come down over time because people are actively seeking them out.
Okay, so you have the DTC model and the brand. What's the third layer?
The third layer is one that I think a lot of tech investors miss. It's the regulatory moat,
The red tape.
all the red tape.
Yeah.
This isn't just software, it's healthcare. And that means navigating this maze of state licensing, prescription compliance, DEA rules.
Sounds like a massive headache, but also a huge advantage if you've already built it.
That's it exactly. Building that compliance infrastructure to operate in all 50 states is incredibly expensive, and it takes years. For a small competitor, it's a huge barrier to entry. For HIMS, it's a durable advantage that protects them.
Okay, so that all sounds pretty compelling, but we have to talk about the other side of the coin. What's the bear case here? What are the risks?
Of course. And no investment is risk-free. A bear case here really centers on two main things.
And the first one has to be that concentration risk in the GLP-1 weight loss market, right?
It's the top risk, for sure.
Yeah.
That market has been the engine for so much of their recent growth. If serious competition from, say, big pharmacy chains heats up, or if pricing pressure comes in, that could really change the story.
So how do they mitigate that?
Well, their strategy's pretty clever. They often use compounded versions of the drugs where it's legally allowed.
Okay, and the difference there is?
It keeps their costs way down, making it much more affordable for consumers who can't get or pay for the big brand name GLP-1s.
Mhm.
But there's a catch.
There's always a catch.
The regulatory oversight on compounding is very, very tight. If regulators or the big drug manufacturers crack down on those rules, HIM's ability to offer that affordable access could be seriously limited.
So even though they're diversified into other areas, a threat to their GLP-1 business is a material risk to that growth engine.
Exactly. Which brings us to the second big risk, just general regulatory headwinds. This is a risk for the entire telehealth industry.
You mean things like state licensing rules changing?
Right, or the DEA increasing scrutiny on how certain substances are prescribed online.
Right.
Any major policy shift could force them to change how they operate, and that could really constrain growth.
So the regulatory moat we just talked about, it could become a regulatory trap if they don't adapt.
It's a double-edged sword for sure.
Okay, so with those risks in mind, let's look ahead. What are the near-term catalysts we should be watching?
The biggest one on the calendar is the Q4 2025 earnings report. That should be out in late February 2026.
And that's critical because it won't just be Q4 numbers. It'll have their first look at guidance for fiscal year 2026.
That's the number everyone will be watching. If that guidance comes in ahead of what analysts are expecting, that's an immediate catalyst. If it's weak, the stock could get reset downwards.
And we can't forget that ongoing catalyst, the buyback.
That's right. That new $250 million authorization runs all the way through November 2028. It's not a one-off event. It's a guaranteed multi-year tailwind for their EPS.
And then there's maybe one more, a sort of speculative macro factor.
Yeah, the Federal Reserve. Look, if the Fed does start cutting rates in 2026, as a lot of people expect,
That should boost consumer spending.
and because HIMS is a direct-to-consumer model where people are paying out of pocket, a consumer with more discretionary cash is a direct benefit to their business. It's a nice potential macro tailwind on top of everything else.
So to kind of sum it all up, the core thesis is really about a platform that's making that tough transition from just pure hypergrowth to profitable, sustainable scale.
Right. The growth is slowing, but that's expected. The key is the margin expansion, that 73.8% gross margin. That proves the business model really works.
And you have management putting their money where their mouth is with that massive buyback, essentially setting a technical floor and signaling that they think the stock is undervalued.
Exactly. So they're positioned for strong growth. They have a clear moat as long as they can navigate that GLP-1 concentration and the regulatory landscape.
A really compelling story of execution meeting a huge opportunity. Keep a close eye on that Q4 guidance, and of course, remember to subscribe for more smart wealth analysis.